So LMI, or lender's mortgage insurance, is a cost that you have to take into account if you're buying a property or even refinancing in some cases. There's already so many costs that you have to deal with when you're dealing with property, like bank fees and government fees, but this is one of those things that might be avoidable for you. Hey guys, welcome back. My name is Fyzee. I make videos about Australian personal finance, and today we're doing an in-depth look at LMI. So before I start, I just want to say that this is not financial advice. We are just looking at things from a general point of view, and this is more of a guide only. The banks and products mentioned in this video have not paid me to promote anything, and this is a very unbiased video. So this video is based on my experience dealing with hundreds of customers that I have educated and helped avoid LMI, and this is based on my learnings as well. So first we're going to look at what exactly is LMI and why you need to pay it. Number 2, how you can actually avoid LMI. And number 3, some very important things that you need to know when it comes to making your decision. The timestamps are listed below for each topic, so you can flick through them as you wish. So what exactly is LMI? Basically, it's an insurance premium that you have to pay if you're planning to borrow over 80% of the property's value. Now, it's very, very important to note that this only protects the bank, not you. A lot of people actually get this wrong. Because if you're borrowing over 80%, the bank deems this to be a high-risk transaction. Therefore, there's going to be a higher cost to you as a customer. So if you were to default, the LMI insurer will compensate the bank will recover the loss, and then you will get whatever is left. Now, this fee is usually non-refundable. You can't just get it back after you've paid it, and most customers add this fee on top of their loan. It depends on your situation and a lot of factors as well. So now that you have a basic understanding, let's look at how you can actually avoid this cost. Now, working as a broker, I've helped a lot of people avoid LMI. So if you're a first home buyer, grants, schemes, and incentives are going to be your best friend. So let's go through these. So number 1 is stamp duty concessions. Now basically, if you're a first home buyer, this means that stamp duty cost is going to be waived completely for you, or it will be waived off to a certain point. Now for investors, this is a significant cost, but since you're a first home buyer, this will be quite good. Now to qualify for the stamp duty concession, you have to be buying in a certain price cap. So if you're a first home buyer, you're going to want to lower your purchase price so you can fit within that box. Just keep in mind that your first home doesn't actually have to be your dream home. You can always start small, live within your means, and then build your way up. If you want to work out the stamp duty calculations for each state, I've put a link in the description, so have a look. This calculator also shows the first home owner's grant as well. So number 2 is the first home owner's grant, or FOG. This is $10,000 or $20,000 if you're in Tasmania or regional Victoria. So just have a look at your state. Generally, if you're building or buying a brand new home and this is your first house and it's for owner-occupied use, you can qualify for this. You also have to live in the house for about 6 months, so keep that in mind as well. Number 3 is the First Home Super Saver Scheme. Now this is a very good way to increase your deposit so you can reduce the amount of LMI that you actually pay. Now how it works is that you can put in voluntary payments to your super through salary sacrifice, or just make a personal super contribution through your after-tax salary. Now the big benefit with this one is that super is generally taxed lower, so you're going to be getting a tax benefit as well, and this way you can really accelerate your savings. So if you're someone who's struggling to save, this could be a good way to lock away your savings for the time being until you're ready to actually make the deposit. Now the 4th method is the First Home Loan Deposit Scheme. Now this one is fairly new and it's for Australian citizens only. The thing with this one, which is quite good, is that you only need a 5% deposit and the LMI will be waived off. But this is only with selected lenders, but the lender choice is quite diverse with up to 27 different lenders, and there are an extra 10,000 spots added this financial year as well. Now once again, this is for brand new properties only, for owner occupied, and house and land packages are also included, and same with off the plan as well. Now the reason why you don't pay any LMI with this option is that the extra 15% out of your 20% is guaranteed by the government, therefore the bank is happy, and hopefully that can work for you as well. Now there are a couple of more requirements, so I put a link in the description for you to have a look. Now the 5th option is the Home Builder Scheme. Now this was actually extended a few months ago, but the only downfall is that it's been reduced to 15K rather than 25K, which it was before. But if you're looking to buy or build in New South Wales or Victoria, the actual price caps have been increased, so you might be eligible for this. Now this is for new builds and off the plan purchases, and this can actually add on with any other schemes as well. So for example, this home builder scheme can be combined with a first home owner's grant scheme plus a stamp duty concession, and you've got a pretty healthy sum there. Now as you guys can see, most of these options are geared towards new homes, new builds, but if you're not actually building new, then what can you do to avoid LMI? Well, you can always increase your deposit. Now, this can be a very tedious process. It can take months, years, but it's really a personal preference. Some people just hate paying extra and they're happy to wait the extra time. Some just want to buy ASAP, pay the cost and build equity in their home as soon as possible. Some people are paying rent at the moment, so if you just want to stop paying someone else's mortgage, you might just want to pay the LMI and just get into your home and stop paying the rent, and this might work for you. Now, as you can see, there is a bit of a trade-off with this, so make sure you do your calculations to see if it's actually worth paying the LMI rather than just paying rent. It's up to you. This is really going to be based on your preferences, and it's up to each individual to decide what's best for them. Now, the other option that you could look at is getting a potential gift. A lot of people who I spoke with had parents who are happy to lend a gift, meaning a sum of money to their children to help with the deposit. Keep in mind that banks still want to see 5% of the property value saved by you through your own savings and not through a gift. If you are paying LMI, then banks will usually request a 3-month savings statement to see if savings are made by you regularly, so keep that in mind. Now, the other option is guarantor. Now, often parents might not have enough savings, but they might have heaps of equity or even a clear title through their family home, or they might have a bunch of investment properties that they can go guarantor on. Then what will happen is the bank will use the house that you're buying as security, plus the guarantor property, which could be your parents' property, as security combined. And as you pay off your home loan and equity gets created in your own house, the bank will release the guarantor from your parents' house. But this option is a bit risky because if you can't pay the home loan, then your parents' property is potentially at risk, along with your own. But if they do have a couple of other investment properties, then of course there's going to be less risk. But let's be honest, not everyone has parents who can support their kids with gifts, guarantors and whatnot. So what can you do? I am running out of options, but here are still a few things that you could do. St. George Bank is giving a special offer at the moment where you'll have to pay only $1 in LMI. But what is the real catch? Well, the LVR can only be up to 85% as a maximum, and you do have to go through a broker. You will still need to come up with the 15% plus other costs, so keep that in mind. But the good thing is that this is not restricted to new homes. This is for existing homes and new homes, but not construction or interest-only loans. So let's say that you're buying a property as a joint applicant. Only one person has to be a first home buyer, the other one doesn't have to be. Now with this option, since you don't have to come up with the extra 5%, this will save you thousands in LMI. You can save time and enter the market a lot sooner. Now I'm not sure how long this will last for. I've put a link in the description so you guys can have a look at the full terms and conditions. So if you're one of those lucky people that's a lawyer, accountant, in the medical field, or even an engineer, the banks will waive LMI for you. Not all of the LMI, but up to 90% LVR, they will get rid of the LMI. Now, different banks are going to have different policies, so go through a broker and see which bank is offering this. And of course, you can get the best deal and the best rate for your scenario. The reason why you pay no LMI is that these professions are seen as less risk for the bank, therefore they're happy to lend more money without LMI. Some banks might need a proof of qualification, so just keep that in mind. Now there's huge benefits to this because you can increase your purchase price, you can save less, save time and buy sooner and not be tied down with a deposit. Hopefully all these methods gave you ideas and helped you out in some way. Let's look into some of the more important things about LMI that you need to know, but before we do, please leave a like if you're finding value so far. Now, as mentioned, LMI is non-refundable. It gets capped on top of the loan and then interest gets charged on it. So if you're going to pay LMI, you'll pay the LMI portion plus you'll pay the interest on top of the LMI. So an LMI cost of 10K will be a couple of $100 for the first year as you pay off the loan. Now, generally we say that LMI is non-refundable, but if you've only been with the bank for say 1 or 2 years and you want to refinance away, they might be able to refund the LMI. I actually looked this up online and apparently this is a thing, so try your luck and see what happens. After all, it doesn't hurt to ask. Now keep in mind that it's very much possible to pay LMI again on the same property. For example, you buy a property at 90% LVR and a few years later the LVR is at about 83%. And you're shopping around and you find better rates somewhere else and you want to refinance. Now, if your property value has gone up, that's great, awesome, congratulations. But if not, or if the property value is lower, you have to pay LMI again with the new bank. Why? Because it's a different bank and they need to protect themselves as well. But if you do go down this path and you want to refinance and there's not enough equity to avoid LMI, then cashback offers are pretty good for this purpose. So with the refinance, you'll be getting the initial saving from the interest rate drop, plus the cashback, plus the actual savings from the fees if there are lower fees with this new bank. A broker can help you decide the benefit of staying where you are or even moving, so check with them. Now the other thing that I want to mention is called the LMI trap. It's basically when your LVR is high and the bank knows that you can't really leave or refinance anywhere else, they are pretty much free to increase rates whenever they can. That's if you're on a variable rate. Now this happens to a lot of people where the benefit of refinancing is not enough or the LMI cost is too high or if the LVR is too high. the lender can pretty much increase the rates as they wish. So what can you do? You can always pay extra into the loan to build equity ASAP, or fix your interest rate. It depends on your scenario. There are very few banks in Australia that do 95% LVR plus LMI, meaning your LVR could be as high as 98%. Now this is not advisable because the bank has complete control over your interest rate, and it is very, very hard to refinance because you pretty much have no equity and you're stuck. And with this, the rates can be as high as over 4%, and in this low rate environment, you want to try and pay as much as you can. But this is an option if you really want to try it. Now, the actual cost of LMI varies between lender to lender. Your broker might be able to look into it and let you know how much the cost is. But generally speaking, it should be the same. Now, LMI is influenced by LVR tiers. Now, for example, LMI at an LVR of 89% will be much lower than an LVR of, let's say, 92%. After 90% LVR, there is a bit of a spike in LMI. So you want to make sure that you can keep below that 90% mark if you can. There's two companies called Genworth and QBE Insurance. These are the main LMI insurers, and they have an LMI calculator as well. I've linked it in the description. If you're super interested in how LMI works and the nitty-gritty and the technicals of LMI, I've linked 2 documents in the description for you to read, because these go into a lot of detail. Now, just a few other things. LMI isn't always charged over 80% LVR. Sometimes it's even charged over 70% LVR depending on the property. Now, this is a very unique case in cases like specialized apartments where the banks really want to try and take as less risk as possible, only in properties like that. This is very unique, and generally it won't apply to your scenario. Now, the LMI insurers have their own guidelines as well, which means that the loan has to get approved by the bank, and then it gets sent off to LMI for approval as well, because ultimately they are the insurer. There's been a few cases where the bank has approved the loan, it's gone to LMI, and LMI has declined the loan, therefore the transaction simply cannot happen. And that is a very risky situation. Speaking of risk, some banks call it a risk fee instead of LMI, but it all just means the same thing in the eyes of the borrower. It just means that money is being sucked away from you. Well, I think I've covered it all. If you're still around, thank you so much for watching. Please leave a heart emoji or something to let me know if you made it this far. LMI is a very important concept when buying a property and refinancing, so hopefully this information puts you in a better position and potentially avoid a financial burden for years to come. Thank you for watching, guys. Please like and subscribe for new videos. Thanks. Please leave a heart emoji. Please leave.